Seeing the Sonic token bleed out at 4 cents probably makes you want to cut your losses. I get it. The migration from Fantom to Sonic in early 2025 was supposed to be the catalyst that changed everything. Instead, the price has collapsed like a rock. But when you look beneath the surface, the on-chain data and the technical market structure are telling two completely different stories. We have a network boasting 400,000 transactions per second, yet it is a complete ghost town. However, their financial architecture is capturing value differently than any other Layer 1. Today, I'm going to show you exactly why I'm not selling my legacy Fantom bag. I'll walk you through the precise invalidation levels, the macro environment, and the exact targets I'm watching for a relief rally. Let us examine the reality of market sentiment. Since the transition from Fantom to the new S token, the chart has been a nightmare for retail investors. The historic October 10th crypto crash accelerated the sell-off, and we are now sitting right around 4 cents. This is a crucial threshold. The fear in the market is palpable. People are capitulating, and the narrative has shifted from extreme hype to extreme pessimism. But here is why this video matters right now, today. We are at a decision point. When a token loses more than 90% of its value, the risk-to-reward ratio drastically shifts. I'm looking for structural inefficiencies. Are we compounding? Are we preparing for a reversal? My strategy relies on capital preservation first and yield second. The metrics I'm about to show you reveal a massive discrepancy between the network's theoretical capacity and its actual adoption. But there's something buried in the fundamentals, specifically regarding their revenue model and developer tooling, that completely changes how we should interpret this 4-cent support level. Let us look at the hard data. The most critical shift for Sonic is their move toward vertical integration. For years, Layer 1 blockchains relied entirely on gas fees to accrue value. That's an outdated model. Sonic Labs is moving away from this structure. They are building and acquiring core protocol applications across trading, payments, and risk markets. Why does this matter to you as an investor? External applications usually keep 99% of revenue. Sonic integrated apps capture 100% to fund S token buybacks. These buybacks are funded by actual protocol revenue, not treasury drawdowns. Over the last year, the protocol generated $1.3 million in revenue from gas fees alone, ranking 12th among all Layer 1s. That proves gas fees are not enough to drive a massive valuation, and it validates their pivot to application-level value capture. But here's where the contrarian data comes in. The network boasts sub-second finality and 400,000 transactions per second, yet actual adoption is virtually non-existent. Sonic is only processing 2.4 transactions per second, ranking 28th. They only have 77,000 monthly active users, which puts them in 25th place. Even worse, developer activity is stagnant. With only 1.4 thousand code commits over the last year, they rank 44th. The infrastructure is a massive, empty highway. However, the capital that is present is highly sophisticated. Sonic currently holds $327 million in active ecosystem loans. That ranks 8th across all blockchains. That is massive. It shows genuine capital efficiency and leverage demand. Stablecoin supply sits at $122 million. And if you have the risk appetite, the liquidity pool yields are extremely aggressive. Few days ago, Equalizer Exchange was offering a 235% annual percentage rate, while others, more liquids like Shadow Exchange, offering 46%. Native staking yields sit around 4.8 to 5.6%, providing a baseline risk-free rate. To solve the developer drought, Sonic just launched Spawn, an AI platform allowing users to generate smart contracts and front ends in plain English. If Spawn works, it drastically lowers the barrier to entry. This fundamental backdrop sets the stage for what we are seeing on the charts.
Now, let me transition to the technical structure on the weekly time frame.
Since the early 2025 migration, price action has been trapped inside a clear descending channel. Following the drastic dump after the October 10th crash, the downward velocity increased. This created a steep descending trendline originating from the local high in October 2025. When you combine this descending trendline with the lower support of the broader descending channel, you can see a massive falling wedge pattern forming. The price is tightening right at the apex of this wedge. It's preparing to make a decision. Currently, we are sitting exactly at the 1618 Fibonacci extension level, which aligns perfectly at 4 cents. This Fibonacci measurement is anchored from the crucial October 2025 dump at 7 cents, up to the subsequent local high of 21 cents. We are below the 10 and 21 exponential moving averages, which act as dynamic resistance overhead. The closest immediate resistance is right at 5 cents. This 5-cent mark is the falling wedge resistance line. Above that, the next hurdle is the 7-cent level, our last lost major support. If you look at the full history monthly chart dating back to the Fantom era, you'll notice that this exact 4-cent level acted as major resistance in 2019 and 2020. Old resistance turns into new support. If we are due for a bounce, it mathematically has to happen around this zone. If this support fails, the next floor is completely empty until 2 cents. Back to the weekly time frame, look at the Heikin-Ashi Relative Strength Index below the price action. It's in extreme oversold territory. More importantly, it's printing a clear bullish divergence against the price action. The indicator is making higher lows while the price has made lower lows. So what's my specific strategy here? As you know from my January update, my short hedge target was perfectly hit. I was stopped out of my short-term long trade. All I have left is my legacy bag from the old Fantom days. It represents less than 0.5% of my altcoin portfolio. It is still in profit, but it has bled significantly. I'm not shorting this asset anymore because it is simply too oversold now. The risk-adjusted returns of holding are better than capitulating at multi-year support. I'm not loading more capital into this position, but for a trader with a high risk appetite, this is the exact load zone you look for. If you are entering now, your strict invalidation level would be a weekly candle close below the falling wedge. I'll not stop out my legacy bag, but new positions must manage risk tightly. I'm looking for a relief rally. My take profit targets are 8 cents, 11 cents, 17 cents, and 22 cents. That 11-cent target perfectly aligns with the 618 fib level and the top of the descending channel. Once the first target is hit, I'll move manually my trailing stop loss to entry. When the second target is achieved, the stop moves to target 1, and so on. Capital preservation is the priority. When we synthesize the fundamental metrics with the highly active loan capital and pair it with an extremely oversold technical chart, the outlook is cautiously neutral to bullish for the long term. This is a high-risk, high-reward environment. The best-case scenario is that the Spawn artificial intelligence tool successfully onboards new developers, fixing the low commit metric. If that happens, the vertical integration model will violently capture value through buybacks, triggering a breakout of this falling wedge. If we close a weekly candle above 5 cents, the probability of hitting our 11-cent target increases drastically. The worst-case scenario is that the network remains empty, the 4-cent support breaks, and we cascade down to 2 cents. I'm letting the chart decide. I don't need it to hit an all-time high. I just need a structural relief rally based on narrative shifts to safely exit. The underlying data proves that Sonic possesses superior financial architecture, but it urgently requires user adoption to flip the momentum. Don't let extreme market fear shake you out at the exact levels where institutions look for liquidity. Be methodical, respect the invalidation levels, and follow the data. If you found this analysis valuable, hit the like button and subscribe to the channel. It tells the algorithm that you value data-driven insights over emotional hype. I highly recommend you join my free Telegram group for faster, daily market updates. The link is right there in the pinned comment. Also, make sure you watch my previous Sonic video covering exactly how we played that short hedge. Remember, none of this is financial advice. This is simply my personal strategy and market observation. Thanks for watching. Manage your risk, protect your capital, and I'll see you soon in the next one.